Today, we are undertaking a deep dive into something you use every single day, something you worry about and work for, but maybe rarely stop to truly analyze money.
It seemed like the most straightforward thing in the world, doesn't it? A unit of account, a medium of exchange, all that textbook stuff.
Right.
But if you've ever stopped to think about, say, where the trillions of dollars that seemingly vanished in 2008 actually went, well, you start to realize how weird and honestly how fragile the whole concept of money really is.
And our sources today, they make one thing perfectly clear right from the start. Money isn't some cold, objective, mathematical thing. It's fundamentally social.
Exactly. It's a shared fiction. It's a made-up thing, resting entirely on human agreement and, crucially, trust.
It's just, what, a number on a computer screen, a piece of paper?
Until we all agree it means something.
Yeah.
That's all it is.
So our mission today is to trace this shared fiction, right? Chart its course from the very beginning, and it gets really messy back there, way before coins.
Oh, yeah. Unbelievably messy. We'll track it through these huge global financial revolutions, crazy speculative bubbles right up to, digital cash and central bank control today.
We're going to see moments of absolute genius, staggering change, politically, economically.
And moments of profound human insanity, too. Let's not forget those.
Definitely not. This is the story of how our collective choices, not some, natural law, created the specific financial world you live in right now.
A world where central banks can, quite literally, conjure trillions out of thin air to fight off an economic collapse. It's wild.
Okay, let's get into it. Let's unpack this. So first thing first, I want to just toss out that classic textbook story about how money started. You know the one. Adam Smith, Jevons.
The barter myth, yeah.
Exactly. The idea that money just popped up to solve the double coincidence of wants problem in barter.
Right. The baker needs shoes, the shoemaker needs bread. They can't find each other easily, so presto, money. It's a neat story.
It is neat. But according to anthropologists who've actually studied societies before money, it's just not true.
Not at all. The consensus is pretty stark. No example of a barter economy, pure and simple, has ever been described. They just haven't found one.
Wow. Okay, so if they weren't bartering bread for shoes, what were they doing? How did stuff move around?
It wasn't about these clunky on-the-spot exchanges. It was much more about relationships, about complex systems of reciprocity, obligation, formal rituals.
So I owe you one.
Kinda, but woven into the entire social structure. Your standing in the community or the family ties, that determined what you could ask for and, crucially, what you were expected to give back eventually.
We actually have a fantastic anecdote for this. Mademoiselle Zélie, an opera singer.
Oh, this is great. Yeah, 1860s. She's on a world tour, stops at this island in the South Pacific. No money used there.
But she sells tickets, 816 of them.
She does. But the payment? It wasn't francs or dollars. Her notes list, 3 pigs, 23 turkeys, 5,000 coconuts.
5,000 coconuts.
And just mountains of other perishable stuff. Fruit, vegetables.
She wrote to her aunt, right? Complaining.
Yeah, totally frustrated. She said her problem wasn't selling the tickets. The show was a hit. Her problem was figuring out what on earth to do with all these proceeds. She wished she could just sell it all for cash.
But she couldn't find anyone to buy 3 pigs, 23 turkeys, and 5,000 coconuts all at once.
Exactly. Because she was thinking in barter terms or cash terms.
Yeah.
The local custom wasn't about resale for profit.
So what should she have done?
The expected thing, the status maximizing thing. Throw a gigantic feast for the whole community, days long.
Ah, okay, give it all away.
Well, not just give it away. By hosting the feast, she gains enormous social standing. And critically, she puts all the guests under an obligation to reciprocate someday. That's the reciprocity economy.
That makes so much sense. And it explains how proto-money, these early forms of value, emerged, right? They were tied into that social fabric.
Precisely. Things like specific rare cowrie shells or those famous long-tusked pigs in Vanuatu. They became valuable not just because they were hard to get, but because they were required for important social stuff.
Like what?
Paying a bride price, settling a major dispute, a specific religious sacrifice. You needed these things for life's big moments.
And that need gives them stored value. If you know you'll need a long-tusked pig for your son's wedding down the line.
You start trying to acquire one now or raise one. It creates an incentive to accumulate them. It even led to a lending system in Vanuatu, apparently, where the interest was calculated by how fast the pig's tusks grew in a circle.
A biological interest rate? That's amazing.
Isn't it? But it also shows how serious this was.
Yeah, you mentioned the stakes were incredibly high. Disputes over these pig debts
Led to murders. An anthropologist noted a high proportion of the disputes and murders were about paying or not paying pig debts.
Wow. So money, even way back then, it's bound up with blood and lust, as the source says. It's not just numbers.
And not at all. It's about power, obligation, social standing. Which brings us to another huge leap, writing.
And the mind-blowing fact that the first writers were accountants, not poets, not storytellers.
Exactly. Mesopotamia, over 5,000 years ago. Cities are getting bigger, too big for just remembering who owes what. They needed a system, especially for tracking tribute owed to the temples or the king.
So they came up with these clay balls.
Hollow clay balls, yeah. And inside, they put little tokens, maybe a cone shape for a measure of barley, a disc for a sheep. You owe 6 sheep, 6 little discs go in the ball, seal it up. It's an IOU.
Oh, physical IOU, very concrete.
Very concrete.
Yeah.
But then came the genius moment. Someone, somewhere, realizes, wait a minute.
What?
Instead of putting the tokens inside, why not just press the shape of the token onto the outside of the wet clay? Make a little mark representing a sheep, a mark representing barley.
Ah, so you're recording the debt symbolically on the surface.
Precisely. And once you do that, what's the point of the tokens inside anymore?
They're totally redundant.
Totally redundant. They just invented abstract symbols for numbers and goods. That's writing, driven by the need to track debts.
So the first novelists were bean counters. That's just something.
It really is. It allowed for economic complexity on a whole new scale. But still, for most ordinary people, life was about tribute and redistribution. You paid your taxes and goods, the central authority redistributed it. Not much need for everyday cash.
Which brings us to coins, finally. Ancient Greece.
Right. After the big Bronze Age kingdoms collapsed, you get these new Greek city-states, the police. They're bigger than tribal villages, so simple reciprocity doesn't scale.
But they're also more egalitarian, maybe less top-down than the old kingdoms, so heavy-handed tribute doesn't quite work either.
Exactly. They needed something different. And standardized lumps of precious metal, usually silver, stamped with an official marketica, coins were the perfect fit for this new, more decentralized society.
And this had a massive impact on work, right? On labor.
Profound. Before coins became widespread, if you were poor in Greece, you likely worked on someone's farm for a whole season or a year. You got room and board, basic security.
Kind of like being tied to the land or the master.
In a way, yes. Coins changed that. Suddenly you could be a day laborer. Work for a day, get paid a few coins at sunset.
That sounds like freedom. You can leave if the master's abusive.
It was freedom, huge freedom. But it came at a cost.
Which was?
Security. Total loss of security.
Yeah.
If there's no work tomorrow or if there's a famine, nobody's obligated to feed you or house you anymore. You're on your own.
So right away, the question pops up. Is this new system the blessing of leisure or the curse of unemployment? Freedom versus precarity.
And that's a tension, that same question, that echoes through every single economic innovation right up to today. Hashtag tag 2, paper revolutions and accidental banking.
Okay, let's leap forward quite a bit. From metal coins to something even more abstract, paper. And China's experience here is just fascinating.
Absolutely radical. Marco Polo, visiting China under Kublai Khan, late 13th century, he just couldn't wrap his head around paper money.
He thought his readers back in Europe would think he was making it up.
Completely. He wrote something like, he was sure they'd never be satisfied that I was keeping within truth and reason. Because to Europeans, value was in the metal, gold, silver. How could a piece of paper be money?
Yet in China, this paper money system was fueling, or at least coinciding with, this incredible economic boom.
A genuine economic revolution. They had movable type printing, the compass, new farming techniques allowing massive surpluses.
Which meant people could specialize, right? Not everyone had to farm.
Exactly. You start seeing professional fish hatcheries, huge silk production operations, people making specialized oils and goods. This wasn't just more people doing the same thing, it was intensive growth. People were getting richer, on average, than their ancestors. A fundamental miracle.
And the money making this possible was pure abstraction, just paper notes?
Well, it had the backing of the Mongol state. Kublai Khan forced people to accept it, reportedly at the peril of his life. So there was coercion.
But it wasn't just coercion, was it? People had been using various forms of promissory notes in China for centuries by then.
Right. They also understood, on some level, that the paper worked because everyone else agreed it worked. The state created the initial trust, perhaps, but widespread acceptance validated the value. It's that shared fiction again.
So what went wrong? Because it didn't last.
Well, the temptation to print too much is always there, especially for funding wars. Kublai Khan did that, causing inflation, but the real reversal was political.
The next dynasty, the Ming.
Yeah, the founder, the Hongwu Emperor. He came from poverty, had seen famine, and he fundamentally distrusted merchants, markets, and the instability that paper money seemed to bring. He associated it with greed.
So he deliberately rolled things back.
Pushed China back towards a system based on tribute paid in goods and using copper coins for smaller transactions.
Yep.
He basically dismantled the paper money system.
And the result?
By the mid-1400s, paper money was gone. And that economic dynamism, it largely stalled. China's economy arguably went backwards for a while.
Yep.
It's a stark lesson in how political ideology can just slam the brakes on economic progress. Maybe things felt more stable, less chaotic, but technically poorer.
Okay. Let's jump to a different kind of problem. Not paper, but bad metal. 17th century England.
Right. Here the issue wasn't too much abstraction. It was that the physical money, the silver coins, were a mess.
People were clipping the edges, shaving off silver.
Constantly. The government wasn't minting enough new full-weight coins, so the coins circulating were often underweight, worth less than their face value. Imagine trying to buy something.
It must have been chaos, constant arguments.
Endless wrangling, as one source puts it. Even fistfights. Contracts started having to specify not just the number of pounds, but the total weight of the silver coins being paid. The metal itself was failing as reliable money.
There just weren't enough good tokens circulating.
Exactly. And this shortage, this unreliability, created the opening for the goldsmiths to accidentally stumble into banking.
How did that work? Rich people had good coins or gold?
Yeah, wealthy folks had gold and full-weight silver coins they didn't want clipped or stolen, so they started depositing them for safekeeping in the vaults of trusted goldsmiths.
And the goldsmith gave them a receipt, a piece of paper.
Right, a paper claim check saying, you deposited X amount of gold with me. Initially, that receipt just represented the specific gold in the vault.
But then came the leap.
The critical leap. The goldsmiths noticed two things. One, people didn't all come back for their gold at the same time. Most receipts just circulated as a convenient substitute for heavy metal.
Okay, so the receipts themselves started acting like money.
Exactly. And two, the crucial insight. If the gold is just sitting there most of the time, why not lend some of it out? Or even better, why not just issue more receipts as loans than the gold they actually had in the vault?
Whoa. So they're creating paper money, essentially, backed by only a fraction of the actual gold.
Precisely. That's the birth of fractional reserve banking. They are literally creating money, these circulating paper claims, out of thin air, based on the assumption that not everyone will demand the actual gold back simultaneously.
Let's just pause on that. It sounds inherently unstable.
It is inherently unstable. It's brilliant for overcoming the money shortage, for fueling investment and economic activity, but the whole system rests on confidence.
If everyone suddenly loses confidence and wants their gold back.
The goldsmith can't pay. The system collapses instantly. That's a bank run.
And this wasn't a new risk, right? Venice, Barcelona, they knew about this.
Oh, yeah. The Venetians had regulations for their money changers, the banchieri sitting on benches, banco, where we got the word bank. And there's that story of a bankrupt banker in Barcelona in 1360 being publicly beheaded. Breaking that trust had serious consequences.
So when did this system first blow up in England?
The big crisis hit London in 1672. King Charles II needed money, borrowed heavily from the goldsmiths, and then basically defaulted on those loans.
Uh-oh, so the goldsmiths are suddenly short?
Very short.
Oh.
Panic ensues. Everyone who holds a goldsmith's receipt rushes to get their gold back before it runs out. The system seized up. A treasury official at the time lamented that his financial tallies were now not money. The trust evaporated.
It raises that fundamental question again. Who do you trust? The government clips coins and defaults. The private goldsmiths are leveraged and vulnerable.
Exactly. It took a while for a more stable solution to emerge in England, which was the Bank of England, a sort of public-private hybrid where Parliament acted as a check on the king's ability to just raid the bank. That tension, that check and balance, turned out to be crucial for stability.
Okay, so that instability, relying on flawed humans like kings or goldsmiths, it pushed some people towards something seemingly more reliable: mathematics.
Right. Let's shift from political trust to the possibility of prediction. And this brings us back to John Law, that Scottish gambler we mentioned.
The guy who fled Scotland after killing someone in a duel.
That's the one. He was brilliant, and he got rich because he understood a brand new field, probability theory.
Before that, how did people think about uncertain outcomes, like winning at dice or whether a ship would return?
mostly attributed to luck, fate, divine will, superstition. Gamblers, though, guys like Pascal and Fermat in France, they started thinking, maybe we can apply math to this.
And they tackled this specific puzzle, the problem of the points.
Yeah, it sounds abstract, but it was fundamental. The question was, if you're playing a game of chance for money, say, first to win 3 coin flips, but you have to stop early.
Yeah.
How do you divide the prize money fairly?
Okay, so say we stop, and I'm winning 1-0 in a best of 3. How do we split the pot?
It seems tricky, right? But Pascal and Fermat's amazing insight was, let's map out every possible future outcome if the game continued.
Ah, okay. So in our 1-0 game, there are 4 possible outcomes for the next 2 flips. HH, HT, THT.
Okay. And if you analyze those 4 outcomes, you'd win 3 of them. HH, TTH. I only win if it's TT.
Yeah.
So since you have a 3 out of 4 chance of winning if the game continued, you deserve 75% of the pot right now.
That's incredibly clever. It's quantifying the future based on possibility.
Exactly. This was revolutionary. The idea that you could mathematically model and predict, or at least assign odds to, uncertain future events, it took gambling out of the realm of pure luck and into calculation.
And this had immediate practical uses beyond the casino, right? Like insurance.
Huge implications.
Yeah.
Take Edmund Halley, yes, the comet guy. He got hold of detailed birth and death records from a town called Breslau.
What did he do with them?
He used them to calculate mortality rates for different age groups. He created the first proper actuarial tables in 1693.
Before Halley, how did things like annuities work? Payments for life.
They were often priced terribly. Sometimes an annuity cost the same whether you bought it for a 20-year-old or a 70-year-old, which is nuts, right? People just bought them for their youngest, healthiest kids. Sellers lost their shirts.
So Halley's tables allowed for fair pricing based on statistical life expectancy.
Precisely. You could finally calculate the actual risk and price it accordingly. This was absolutely critical for things like the Scottish Minister's Widows Fund.
Tell me about that.
They used these new actuarial methods to figure out exactly how much each minister needed to contribute to ensure their widows would be provided for. They made a prediction for the fund's value 10 years out.
And how close were they?
Off by less than 1%. It was astonishing proof that math could manage long-term financial uncertainty.
So insurance, which comes out of this, it's like a modern mathematical version of that old community reciprocity, spreading risk.
In a way, yes. It's pooling resources based on calculated probabilities, rather than just social obligation. And it's the direct ancestor of modern Social Security, state pensions, all that stuff.
This ability to calculate future risk, to bring future value into the present, that leads us straight to the stock market, doesn't it, in Amsterdam?
Absolutely. Our source calls finance time travel. Think about those Dutch spice merchants in the early 1600s. They needed a ton of money now for ships, crews, supplies for voyages that might take years and might fail completely.
How do you get people to front that kind of cash for such a risky long-term bet?
Finance solves this. Investors give up money they could spend today in exchange for the possibility of a much larger return years down the road. It's pulling future potential profit into the present to fund the venture.
Early on, these were just one-off voyage partnerships, right?
Yeah, very ad hoc. The game changer was 1602, the creation of the VOC, the Dutch East India Company. This wasn't just a partnership. It was arguably the first modern multinational corporation open to investment from almost anyone.
And it was chartered for 21 years. That's still a long time to wait for your money back.
Exactly. Investors needed an exit strategy. What if you needed cash before the 21 years were up, or before the ships even returned? So the VOC charter included one seemingly small but utterly revolutionary clause.
What was it?
It allowed shareholders to sell or transfer their shares to someone else, simply by registering the change with the company bookkeeper.
Ah, liquidity. You don't have to wait for the voyage to end. You can sell your share to another investor whenever you want.
That single line created the possibility of a secondary market. It gave birth to the modern stock market. People started trading these VOC shares so furiously on a bridge in Amsterdam that it literally blocked traffic.
So they had to build a dedicated building.
Yep. Amsterdam commissioned the world's first purpose-built stock exchange.
And almost immediately, people started getting clever with trading, right? Like Isaac Lemaire.
Oh, yeah. Lemaire had a falling out with the VOC leadership, so he essentially invented short selling. He started making contracts to sell VOC shares in the future at a specific high price, betting that the actual market price would fall before that date.
So he could buy the shares cheap later on, deliver them at the agreed high price, and pocket the difference.
Exactly. And to help the price fall, He allegedly started spreading rumors. The ships are sinking, management is corrupt, the classic short seller tactics we still see today.
How did the VOC react?
They freaked out. They saw Lemaire as undermining the company, preying on honest investors, widows, and orphans. They successfully lobbied the Dutch government to ban short selling.
But Lemaire had a point, didn't he? Maybe the price should have been lower if the company was being mismanaged.
That's the crucial insight here. The VOC directors saw short sellers as purely destructive. But Lemaire argued he was just reflecting reality. The point of a stock market isn't just for prices to go up. It's to find the right price, the price that reflects all available information.
Including the bad news, the pessimistic outlook.
Yes. Allowing short selling incorporates that negative information into the price. When you ban shorts, you might prop up the price temporarily, but you risk letting the market become disconnected from reality, making it more prone to bubbles and crashes later on. It needs that tension. #Tag 40. John Law, The Great System, and the Invention of Millionaires.
Speaking of bubbles, let's get back to John Law. His grasp of probability, combined with seeing the chaos of clipped coins and bank runs, convinced him money wasn't natural, it was artificial, it could be managed, created.
Then he first proposed his big idea in Scotland.
Yeah, around 1705. He saw Scotland had resources, potential, but it lacked money, credit. It was stagnant. His radical proposal, a government-backed bank that would issue paper money.
But not backed by gold or silver. No, backed by the value of land itself. This was way out there for the time. But Law fundamentally understood that money is about trust. He believed a well-managed state could create that trust and therefore create prosperity by issuing paper.
Scotland said no thanks.
They thought he was nuts, but then he found his big chance in France.
France was in bad shape after Louis XIV.
Absolutely bankrupt, crushed by war debts. The old king dies, the Duke of Orleans becomes regent, and he's desperate for a solution. Law arrives in Paris, pitches his ideas, and the regent, maybe out of desperation, gives him a shot.
So Law sets up his bank, the Banque Générale, later the Banque Royale. It starts printing paper money.
Paper money backed by the authority of the French state. That's step one. Step two was the Mississippi Company.
This was granted a monopoly on trade for basically all of French North America, Louisiana.
A vast, largely unknown territory. Law gets the monopoly rights. Then comes the truly genius part, connecting the bank, the company, and the government's massive debt.
How did he do that?
He allowed French citizens who held existing government bonds, which were seen as unreliable, and paid high interest to swap them for shares in his exciting new Mississippi Company. Crucially, these shares paid a lower interest rate.
So the government gets its debt consolidated at a lower rate, and investors swap shaky government paper for shares in this venture, promising untold riches from the new world.
Exactly. It seemed like a win-win, and it set the stage for the bubble. Because Law then structured new share offerings in a way that created frantic demand.
How? What was the mechanism?
To buy the newer, often cheaper issues of Mississippi stock, you first had to own some of the older, more expensive shares. It created this built-in, escalating demand. Everyone needed the old shares to get the new ones.
The price just went vertical.
Exponentially. People went absolutely mad trying to buy stock. The accounts from the time are incredible. Huge crowds mobbing the company offices on the Rue Quincampoix.
People climbing through windows, falling down chimneys.
Literally. One story tells of a man falling down the chimney into Law's study just trying to get his hands on shares. It was pure mania.
And this is where the word millionaire comes from.
It was coined right then and there, in Paris, 1719, to describe the people, often quite ordinary folks, who became fantastically overnight wealthy from their Mississippi Company stock. Fortunes were made in days.
But the bubble was completely detached from reality, wasn't it? What was actually happening in Mississippi?
Almost nothing. The promised emerald mountains, silver mines, total fiction. By 1719, the capital, New Orleans, apparently had only 4 houses built. There was no flood of wealth coming back from America.
So how did Law keep the illusion going?
He became desperate. He started resorting to rounding up vagrants, criminals, even prostitutes, and forcibly shipping them to Louisiana as settlers, just to create the appearance of activity and progress.
The whole thing was built on air. The paper economy has zero connection to the real economy.
Completely disconnected.
Yeah.
The collapse came inevitably when people started trying to cash out their paper millions for actual gold and silver.
The classic run.
The classic run. Law tried everything. He made it illegal to own large amounts of gold or silver coin. People started buying huge gold crosses and jewelry instead.
Until he banned those two.
Until he banned those two, it was hopeless. The system imploded.
So what was the fundamental flaw? Was it just that paper money itself is flawed?
Law and his ally, the Duke of St. Simon, actually argued later that the paper money itself wasn't the core problem. Paper money could work.
So what was it then?
St. Simon diagnosed it brilliantly. Law's system lacked tension. In England, you had the Bank of England, but it was checked by Parliament. There was pushback, accountability.
But in France,
Yeah.
absolute monarchy.
Law basically had the regents, and thus the states, unlimited backing. There was no counterforce, no one to say, hold on, maybe printing more isn't wise. As St. Simon put it, the king would inevitably get carried away. Absolute power, combined with the temptation of the printing press, was fatal. Paper money needs checks and balances to survive. ###ve. Abundance, cheap light, and the price of progress.
John Law's story feels very zero-sum, right? A few got rich, then everyone lost. But the bigger story, over the centuries after Law, is actually different. It's about productivity growth.
Exactly. It's the story of how, in real terms, it becomes possible for everybody to have more money, more wealth, not just redistributing a fixed pie, but baking a much, much bigger pie.
And the history of artificial light is an amazing way to see this. Economist Bill Nordhaus tracked this.
It's incredible. For literally thousands of years, think ancient Babylon right up to maybe the 1700s in Europe, getting light after dark was incredibly expensive and difficult.
How expensive, like in terms of labor?
In Babylon, a full day's work might buy you about 10 minutes of light from a basic sesame oil lamp. Even by the 1700s, using tallow candles or maybe whale oil, a day's labor bought you perhaps an hour of light, tops.
So the world was just dark most of the time.
Dark, dangerous after sunset. Economic activity largely stopped. Life was constrained by daylight. Sometimes people even used oily dead birds like storm petrels threaded with a wick for a feeble light source.
Wow. Okay, so when did that start to change?
The Industrial Revolution. The first big leap was kerosene, refined from petroleum around the 1850s. Suddenly, it was much cheaper, brighter, cleaner.
How much cheaper?
A day's wage could now buy maybe 5 hours of decent light. That's a 5-fold increase in just 50 years, matching the gains of the previous 4,000 years.
But the real game changer was electricity. Thomas Edison.
Edison and the light bulb. But Edison's story isn't just about invention. It's also about financing invention. He needed huge amounts of capital for his invention factory in Menlo Park workshops, skilled machinists, materials.
How did he get that kind of money? It wasn't like venture capital back then.
The crucial financial innovation was the rise of the Limited Liability Corporation, the LLC.
What did that do?
It fundamentally changed the risk for investors. With an LLC, if the company went bust, the investors only lost the money they'd put in. Their personal assets, their houses, their savings were protected.
Ah, so it dramatically lowered the barrier to investing in risky new ventures like Edison's.
Massively. It made it much easier for Edison to raise substantial funds like $50,000, which was maybe $1 million in today's money, based largely on the promise of his future patents. The patents gave the potential monopoly, but the LLC structure unlocked the capital needed for that large-scale R&D.
And the result, in terms of light?
It's just staggering. Add up kerosene, the light bulb, continuous improvements in generation and efficiency. Today, Nordhaus calculated, a day's labor buys something like 20,000 times as much artificial light as it did just 2 centuries ago.
20,000 times. That's abundance. That's how real wealth gets created for almost everyone, in terms of what your work can buy.
Well, that's the miracle of productivity growth.
But there's always a but, isn't there? The sucking part, as our source puts it. How does society actually get richer?
Paradoxically, it often gets richer by destroying specific jobs, specific ways of life. When a machine can do the work of 10 weavers, or one day, maybe one driverless truck does the work of a human trucker.
Society as a whole benefits from cheaper goods or transport.
Massively. But the weaver, the truckers, they suffer immediate, often devastating consequences.
Which brings us to the Luddites, early 19th century England.
Yeah, and we had this caricature of them as just mindless thugs smashing machines because they hated progress.
But that's not accurate.
Not really. They were mostly highly skilled artisans, weavers, cloth finishers called croppers, who had good livelihoods, status, control over their work. They saw these new machines like power looms and shearing frames as threats that would not only take their jobs but also de-skill the work and drive down wages for everyone.
So their protests smashing the machines, it wasn't just random violence.
It was targeted. It was, as one historian called it, collective bargaining by riot. They were trying to resist the destruction of their livelihoods and their communities.
How did the authorities react? This was just after the French Revolution, right? They must have been nervous.
Terrified, absolutely terrified of any popular uprising. Parliament rushed through laws making frame-breaking, destroying these machines a capital offense, punishable by death.
Lord Byron spoke out against this.
Famously. He gave a passionate speech in the House of Lords, defending the Luddites, arguing they were driven by absolute want and desperation, not malice, and that the penal code was already far too harsh.
But his plea didn't work.
No. The crackdown was brutal. There was the famous Battle of Cartwright's Mill in 1812. About 150 Luddites attacked a heavily fortified mill.
Fortified?
Oh yeah, the owner was ready. He had armed soldiers waiting, maybe even, according to legend, a vat of sulfuric acid ready to dump on attackers. The Luddites were repulsed. Several were killed.
And many were caught and executed later.
Yes, hanged. It broke the movement. But the tragic thing is, the Luddites were essentially right in the short to medium term.
What do you mean?
Technology did destroy their livelihoods. And for the entire first half of the 19th century, while industrial productivity soared and factory owners got fabulously wealthy, the average real wages for British workers barely increased at all.
So the gains from technology took decades to trickle down to ordinary people.
Decades. The Luddites knew they wouldn't benefit quickly, if ever. It's a harsh reminder that while technology can make everyone richer in the long run, as Keynes famously said, in the long run, we are all dead. Or as our source puts it, the long run can be really, really long. So in this world of industrial change and disruption, the gold standard emerged as this appealing idea. Money that was supposedly natural, stable, objective, not subject to the whims of politicians like John Law or the chaos of clipped coins.
And this idea had philosophical backing. You mentioned David Hume.
Scottish philosopher, yeah. He attacked the old mercantilist idea that a nation's wealth was measured by how much gold and silver it piled up through trade surpluses, using tariffs and quotas.
Hume said that was wrong. Gold isn't wealth.
He argued it wasn't the ultimate measure. He used this brilliant thought experiment. Imagine, he said, if Britain magically lost 80% of all its gold overnight.
Okay, what happens?
According to Hume, prices for everything in Britain would instantly collapse. British goods would become incredibly cheap compared to the rest of the world.
So exports would skyrocket. Everyone would want to buy cheap British stuff.
Exactly. And foreigners would pay for these goods.
Yeah.
In gold. So the gold would automatically flow back into Britain until prices eventually equalized with the rest of the world again.
It's like a self-correcting mechanism.
That was Hume's point. Gold flows automatically balance trade. You don't need governments interfering with tariffs. The system takes care of itself. Money is neutral in the long run.
This thinking underpins the gold standard.
It provided the intellectual justification. Britain stumbled onto a full gold standard almost by accident in 1816, fixing the pound sterling to a specific weight of gold.
And other countries followed.
Eventually, yes. By the late 19th century, most major economies were on the gold standard. This created a period of remarkable exchange rate stability. You always knew, for instance, that $4.87 equal to 1 British pound.
Which must have been great for international trade and investment.
Fantastic. It fueled the first great wave of globalization before World War I. Predictable currencies made everything easier.
Okay, sounds good so far. Stable, predictable, self-correcting. What was the downside? Why did the love story go south?
The big problem was deflation. The world economy was growing rapidly. More goods, more services. But the global supply of newly mined gold wasn't keeping pace.
So you have more stuff being produced, but roughly the same amount of gold money chasing it.
Exactly. Which means the value of each gold-backed dollar or pound went up over time. Or, put another way, prices for goods and services tended to fall continuously.
Falling prices sound good. Don't we like sales?
It sounds good if you're a creditor, someone who has money saved or is owed money. Your money buys more each year. But if you're a debtor...
Like a farmer who borrowed money to buy land or equipment?
It's devastating. You borrowed dollars when they bought less, and now you have to pay back those same dollars, but they're worth much more. You have to produce and sell more wheat, more cotton, just to make the same fixed mortgage payment. It squeezed debtors relentlessly.
This created huge political tension, right? Especially in America.
Massive tension. It culminated in the U.S. election of 1896. William Jennings Bryan, the Democratic candidate, became the voice of the indebted farmers and workers.
He wanted to add silver to the money supply. Free silver.
Exactly. Coin silver alongside gold to increase the amount of money circulating, stop the deflation, maybe even cause a little inflation to give debtors some relief. He framed it as a moral crusade against the bankers and the East Coast elite.
And this led to his famous Cross of Gold speech.
One of the most electrifying speeches in American history. He thundered against the gold standard defenders. "You shall not press down upon the brow of labor this crown of thorns. You shall not crucify mankind upon a cross of gold."
Chills. But he lost the election.
He lost to William McKinley, the Republican, who defended the honest dollar backed by gold. McKinley's campaign, funded by big business, framed gold as representing responsibility, thrift, sound finances. Americans, perhaps nervously, chose McKinley's stability over Bryan's call for radical change.
So the gold standard survived, but the problems didn't go away.
No. And later, economists like Irving Fisher, who had actually supported gold earlier in his career, came to realize its deep flaws.
What does Fisher figure out?
He realized that, in practice, things like interest rates and wages don't adjust quickly or perfectly to deflation. So falling prices weren't neutral. They actively harmed debtors and tended to slow down the whole economy by discouraging borrowing and investment.
And he talked about the money illusion.
He became obsessed with this idea. People fundamentally think a dollar is a dollar is a dollar. They don't easily grasp that its purchasing power is constantly changing.
Like his example of movie earnings.
Right. He'd point out, hey, Gone the Wind made $200 million in 1939 dollars. That sounds like less than a modern blockbuster making $900 million. But because of inflation, those 1939 dollars were worth vastly more. People suffer from this illusion, thinking money has a fixed value when it doesn't.
So what was Fisher's solution if gold wasn't the answer?
His big idea, which is really the foundation of modern monetary policy, was stop defining the dollar by a fixed weight of gold. Instead, define it by its ability to buy a fixed basket of goods. Aim for stable purchasing power, not a fixed link to a shiny metal.
Manage the money supply to keep prices generally stable.
Exactly. He wanted people to understand that if all prices went up 10%, it wasn't that goods got expensive. It was that the purchasing power of the dollar fell. He saw the gold standard as built on this illusion, a fixed weight of gold masquerading as a unit of value.
And clinging to that gold standard, especially during the Great Depression,
would prove catastrophic. #7, the American fight over a central bank.
So the debate in America wasn't just gold versus silver. It was this deeper fight about who controls money. And this goes way back, long before the Fed, the second bank of the United States. Nicholas Biddle.
Right. Mid-19th century America was a financial Wild West. You had thousands of different banknotes issued by state-chartered private banks, many of them pretty shapy.
No single national currency.
Not really. Biddle ran the second bank of the U.S., which was a federally chartered institution. He tried to act as a sort of proto-central banker, even though that term didn't exist yet.
How did he exert control?
His bank was large and held notes from all these smaller state banks. Periodically, Biddle would suddenly present large amounts of a state bank's notes back to them and demand payment in gold or silver, specie.
Forcing them to prove they actually had reserves. To curb risky lending.
Exactly. It was a way to impose discipline on the system to prevent banks from just printing notes recklessly. Biddle was powerful, maybe the second most powerful man in America.
But he clashed with the most powerful man.
Andrew Jackson. Old Hickory. Jackson was a populist, a frontiersman, deeply suspicious of banks, paper money, and Eastern elites. He saw Biddle's bank as an undemocratic monster, concentrating power and benefiting the rich.
The famous bank war.
Jackson vetoed the bill to recharter the bank, railing against its too much power. He basically destroyed it. And his populist argument won the day. The U.S. wouldn't have any kind of central bank for another 70 years.
So what happened during those 70 years? The free banking era?
Chaos, basically. The number of state banks exploded, each issuing their own distinct banknotes. The Chicago Tribune once estimated there were 8,370 different kinds of money circulating.
8,370? How did anyone conduct business?
With great difficulty. Imagine being a shopkeeper. Someone pays with a $2 note from, say, the Bank of Waupun, Wisconsin. You'd have to pull out your copy of Thompson's Banknote Reporter,
What was that?
a regularly published guide that listed all the banks, described their notes. The $2 Waupun note apparently featured Santa Claus, and crucially indicated whether the bank was still solvent and what discount rate you should apply based on how far away the bank was.
You'd have to discount money based on distance. That's insane.
It was cumbersome, inefficient, and prone to fraud. And the whole system was racked by periodic financial panics, essentially. Bank runs leading to recessions. They happened constantly.
Until the really big one, Panic of 1907.
That one nearly brought the whole system down. It was so bad that the only person with enough clout and resources to stop it was the private banker, J.P. Morgan.
What did he do?
He famously locked all the major New York bankers in his private library and basically strong-armed them, kept them there all night, until they agreed to pool their resources and bail out the failing institutions. Private power saved the day, but it showed the system was broken.
That must have been the catalyst for creating the Fed.
It was. But Americans, thanks to Jackson's legacy, were still deeply suspicious of a powerful central bank. So Senator Nelson Aldrich had to be clever.
The secret meeting on Jekyll Island.
Yep, 1910. Aldrich invites a small group of the country's most powerful bankers to a private club on Jekyll Island off the coast of Georgia. They traveled incognito, pretending to be duck hunters.
Why the secrecy?
To avoid public outcry. They spent days secretly plotting out the structure for a new central banking system, one they deliberately agreed not to call a central bank to make it politically palatable.
And this secret plan became the basis for the Federal Reserve.
Largely, yes. The Federal Reserve Act of 1913 created the system we have today, 12 regional Fed banks, overseen by a board in Washington. Its notes were declared obligations of the United States. It was designed to provide an elastic currency and prevent future panics.
But it didn't prevent the biggest panic of all, the Great Depression.
No. In fact, the consensus now, heavily influenced by the work of Milton Friedman and Anna Schwartz, is that the Fed's actions, or inactions, made the Depression far worse than it needed to be.
How so? What did they do wrong?
They failed in their core mission. They didn't act decisively as a lender of last resort to save sound banks during the initial waves of runs. And worse, in 1931, as the economy was cratering, they actually raised interest rates.
Why on earth would they do that?
Because they were still mentally bound by the rules of the gold standard. Gold was flowing out of the country, and the old rules said you had to raise interest rates to attract gold back. They followed the gold rules instead of focusing on the collapsing domestic economy.
So Friedman and Schwartz argued the Fed turned a bad recession into an absolute cataclysm.
That was their central argument. By prioritizing gold over economic stability, the Fed allowed the money supply to contract massively, deepening the Depression.
So when FDR came into office in 1933, the system was in free fall.
Total collapse. Banks were closing everywhere. States were declaring bank holidays. Some cities were even printing their own emergency paper IOUs just to allow basic commerce. Money itself was disappearing.
And FDR took drastic action, influenced by Irving Fisher's ideas about managing the dollar.
Absolutely. First, he declared a nationwide bank holiday to stop the runs. Then, crucially, through Executive Order 6102, he effectively took the U.S. off the domestic gold standard. He ordered Americans to turn in their gold coins and bullion to the government in exchange for paper dollars.
He broke the link to gold.
He broke the link. And then he announced the government would deliberately devalue the dollar relative to gold, essentially, promised to make prices rise.
The opposite of the deflation they'd been suffering under.
Exactly. It was a psychological masterstroke based on Fisher's ideas. By changing expectations, by signaling an end to deflation, he managed to break the downward spiral. One of his advisors captured the shift perfectly, writing to him condemning the old view that placed an artificial gold standard among nations above human suffering. FDR chose human suffering. He killed the domestic gold standard to save the economy. #8th. The new money, shadow banks, and the Euro challenge.
Okay, so we killed the gold standard domestically, but the impulse to create new forms of money, especially outside the regulated system, never goes away, does it?
Never. Fast forward to the 1970s. We get another fascinating example. The invention of a whole new kind of money, basically by two guys looking for a loophole.
Who were they? What was the loophole?
Bruce Bent and Henry Brown. The loophole was Regulation Q, a federal rule that put a cap on the interest rates banks could pay on regular savings deposits. Rates were low.
So savers weren't earning much.
Right. Bent and Brown came up with the money market mutual fund. The idea was simple. Create a mutual fund that invests only in super safe short-term debt. like U.S. Treasury bills.
Okay, sounds like a safe investment fund. What was the trick?
The trick was they decided to fix the price of each share in the fund at exactly $1. Always. Any interest earned would be paid out as additional $1 shares.
So it looked and felt just like a bank deposit. Your balance was always stated in dollars, stable at $1 per share.
Exactly. And you could even write checks against your account in the money market fund. It functioned like a checking account.
But it paid higher interest rates than banks because it wasn't subject to Regulation Q.
Precisely. It was brilliant. It offered safety, liquidity like a bank, and higher returns. Money poured into these funds.
But it wasn't a bank, right? No FDIC insurance.
Nope. No deposit insurance, no capital requirements like banks, minimal regulation. It existed in the shadows of the traditional banking system, hence shadow money.
And this system grew. Huge.
Massively. Trillions of dollars. And over time, these funds started reaching for higher yields by investing in slightly riskier short-term debt, like asset-backed commercial paper issued by investment banks. This shadow money became the grease lubricating the entire financial boom of the 2000s.
So you had this enormous parallel banking system doing bank-like things, borrowing short-term, lending longer-term, but without the safety net.
Exactly. Economist Paul McCulley, who coined the term shadow banking, saw the danger clearly. He recognized it was the same fundamental risk as those 17th century goldsmiths. The potential for a run if confidence wavered.
And the run came in 2008.
It started with Lehman Brothers. Bruce Bent's original fund, the Reserve Primary Fund, held about $785 million worth of Lehman Brothers commercial paper short-term IOUs.
When Lehman went bankrupt.
That paper became worthless overnight. The Reserve Primary Fund suddenly couldn't maintain its fixed $1 share price. It broke the buck, falling to about 97 cents per share.
Only a 3% loss, but psychologically devastating.
Catastrophic. The promise of absolute safety, the $1 peg, was broken. Panic erupted instantly. Everyone with money in any money market fund suddenly worried theirs might break the buck next.
So they all tried to pull their money out at once.
A massive run on the entire shadow banking system. Billions, then trillions were withdrawn in days. The credit markets froze solid.
And the government had to step in.
President Bush had to go on TV and announce that the U.S. Treasury would temporarily guarantee money market funds, just like bank deposits. It was a stunning admission. This shadow money, created by loophole, had become so vital to the economy that it was effectively real money and needed a taxpayer bailout. The public picked up the tab for decades of unregulated growth.
This theme of fragility, of needing a unified backstop, also connects to the euro, doesn't it? Another grand monetary experiment.
Absolutely. The euro's origin story is deeply political. It really gained momentum after the fall of the Berlin Wall.
France was worried about a powerful, reunified Germany.
Exactly. French President Mitterrand saw a single currency as a way to bear hug Germany, to bind it into a European structure and prevent it from dominating the continent economically.
And Germany agreed. They gave up the Deutschmark, which was like their symbol of post-war stability.
They did, essentially as the price for French agreement to German reunification. They traded their beloved mark, their flag, for national unity.
But there was a fundamental clash in philosophy built into the euro from the start.
A huge divide. The French tradition saw money more as a tool of the state, something to be managed to promote growth, employment. Politicians should have influence.
Whereas the Germans, haunted by 1920s hyperinflation.
Absolutely obsessed with price stability. Their Bundesbank was fiercely independent, and they believed money must be protected from political interference at all costs. Keep inflation down no matter what.
So the euro ended up with a central bank, the ECB, designed mostly on the German model, focused solely on inflation.
Pretty much. They got the German-style independent central bank, but what they didn't get was the necessary political union to go with it.
What do you mean, what was missing?
They lacked a shared treasury, a strong central budget, automatic fiscal transfers between countries, labor mobility, basically all the things that make a single currency work smoothly in a large, diverse area like the United States.
Can you give an example? Like if one U.S. state has a recession.
Right. If, say, Texas has an oil bust, federal taxes paid by Texans go down automatically, while federal unemployment benefits flowing into Texas go up. Money automatically transfers from booming states like California to struggling states like Texas. Plus, people can easily move from Texas to California to find work.
But in the Eurozone, if Greece or Spain hit trouble after 2008?
They were trapped. They couldn't devalue their own currency to become more competitive. They didn't have one.
Yeah.
They couldn't lower their own interest rates. The ECB set rates for everyone, focused on Germany's needs. They didn't get automatic fiscal help from Germany. All they had was painful austerity forced on them.
They'd given up monetary sovereignty without getting the benefits of political union.
Exactly. The euro crisis exposed that fundamental flaw. It only stabilized when the ECB head, Mario Draghi, finally stepped up in 2012 and basically broke the German rules.
His whatever it takes moment.
Yes. He simply promised the ECB would do whatever it takes to preserve the euro. The promise itself, the sheer political will, was enough to calm the markets. It proved, yet again, that modern money isn't about gold or rules. It's ultimately about trust in the people in charge, the central bankers, and their willingness to act decisively, even magically, in a crisis. So all these crises, this complexity, the feeling that the system serves elites, it inevitably fuels a search for something completely different. A new kind of money.
And that often starts with privacy concerns, right? Even back in the 80s.
Yeah, a computer scientist named David Chaum was way ahead of his time. He invented a form of anonymous digital cash back then. He was worried about the rise of databases, the tyranny of the bank ledger, tracking everything everyone buys.
He wanted electronic money that worked like physical cash, private, untraceable transactions.
Exactly. Corporations like Citibank and Microsoft actually tried to commercialize his ideas in the 90s, but they never really took off.
But the idea didn't die. It got picked up by the cypherpunks.
Right. This group of radical libertarians, cryptographers, privacy advocates online, they dreamed of a truly stateless, anonymous, censorship-resistant digital money, completely outside government or bank control.
But they faced a huge technical hurdle, the double spending problem.
That was the killer app problem. With physical cash, once you hand it over, you don't have it anymore. But with digital information, anything can be copied perfectly. How do you create digital money that someone can't just copy and spend multiple times without having a central authority like a bank, keeping track of every transaction?
Seemed impossible without a trusted middleman.
Until Satoshi Nakamoto, whoever he, she, or they are, came along in 2008. Bitcoin. Satoshi brilliantly combined several existing ideas, Chaum's privacy focus, cryptographic hashing, peer-to-peer networking, and added the key innovation, the blockchain.
The distributed public ledger.
A ledger of every transaction, copied and held by everyone on the network, no central authority. And to make it work, Satoshi incentivized people, miners, to validate transactions and add them to the chain by rewarding them with newly created Bitcoin. Solving computational puzzles proved their work and secured the network.
And the timing wasn't accidental, right? Launched right in the middle of the 2008 financial crisis.
Deliberate, it seems. The very first block mined on the Bitcoin blockchain, the Genesis block, contains the text of a headline from the Times of London. Chancellor on brink of second bailout for banks.
A clear political statement.
Absolutely. Satoshi's accompanying white paper explicitly stated, the root problem with conventional currency is all the trust that's required to make it work. Banks must be trusted. Governments must be trusted. Bitcoin was designed to be trustless.
But has it lived up to that promise? Can it function as money?
Well, the reality is complicated. Its price volatility is just insane, tripling one year, crashing the next. That extreme instability means it doesn't really function as a reliable unit of account or a stable medium of exchange, which are core functions of money.
People talk about the price of Bitcoin, not just using Bitcoin.
Exactly. It's traded primarily as a speculative asset like digital gold, not used like everyday currency. It hasn't replaced conventional money.
Okay, so if Bitcoin isn't the definitive future, what are the plausible paths forward for money based on everything we've discussed?
Our sources suggest maybe three big, fundamentally different directions we could go. Each involves getting rid of something we currently take for granted.
Okay, what's the first one?
A world without cash. Physical cash, especially large bills, $100, 500 euros, is still surprisingly popular, growing faster than GDP in many places. But economist Ken Rogoff argues most of this cash is used primarily for illegal activities, crime, tax evasion.
So his proposal is just get rid of physical cash, or at least big bills.
Exactly. Force everything into the digital traceable banking system. Rogoff argues this would significantly curb crime and the gray economy. Plus, there's another big potential benefit for central banks.
What's that?
If there's no physical cash to hoard, central banks could push interest rates below zero during a severe recession. Negative interest rates.
Paying the bank to hold your money, to encourage spending.
Right. Currently, they can't really do that effectively because people would just withdraw cash and stuff it under the mattress if rates went negative. Eliminating cash removes that lower bound.
Okay, so that's one future. Cashless, Maybe more central bank power? What's a second?
A world without banks, or at least banks as we know them. This idea actually goes back to economists like Irving Fisher. Even Milton Friedman flirted with it. It's called full reserve banking, or sometimes narrow banking.
What's the core idea?
Radically separate the basic functions of money. You'd have safe banks that are essentially just payment processors and warehouses. For money, they'd have to hold 100% reserves against all deposits. Your money would be perfectly safe, like putting valuables in a safety deposit box.
So no fractional reserve lending by these institutions, no risk of runs.
None at all for the basic deposit payment system. All the risky lending mortgages, business loans, would have to be done by separate institutions funded purely by investors who understand and accept the risk, not by depositors who think their money is perfectly safe.
What would be the effect of that?
It would theoretically end bank runs and the too-big-to-fail problem and eliminate the need for deposit insurance. But it would also likely mean less credit available overall, and it would shift enormous power away from private banks and towards the central bank, which would likely have much more direct control over the money supply.
Okay, cashless world, bankless world. What's the third possible future?
It's maybe the most radical, politically, modern monetary theory, or MMT.
We hear a lot about MMT. What's the gist?
MMT challenges the whole way we think about government budgets and debt, at least for countries that issue their own currency, like the US, UK, or Japan.
How so?
It argues that such a government can never involuntarily run out of its own currency. It can always create more money to pay any bill denominated in that currency. Therefore, worrying about government deficits or debt ceilings is largely misplaced.
So the government can just spend whatever it wants, print money to fund everything. That sounds like it leads to hyperinflation.
MMT proponents say no, not necessarily. The real constraint on government spending isn't the deficit number. It's real resources and inflation. As long as there are unemployed people and idle factories, the government can spend more money into the economy without causing significant inflation.
So what's the role of taxes in MMT? It's not primarily to fund spending.
No. MMT argues taxes serve two main purposes. First, to create demand for the government's currency. You need dollars to pay your U.S. taxes. And second, crucially, to manage inflation.
How does that work?
If the economy starts overheating, if there's too much money chasing too few goods and inflation rises, then Congress should raise taxes to pull money out of the economy and cool it down. If the economy is slow, Congress cuts taxes or spends more. Fiscal policy becomes the primary tool for managing the economy, not monetary policy by the central bank.
This really shifts the power, doesn't it?
Yeah.
From unelected central bankers setting interest rates to elected politicians managing spending and taxes.
Fundamentally, it poses a huge political question. Who do you trust more to manage the economy and the value of money? Technocrats at the Fed, who are insulated from politics but maybe prioritize stability over employment? Or elected representatives in Congress who are democratically accountable but might be tempted to spend recklessly for short-term political gain?
Wow. 3 very different potential futures.
And the key takeaway from this whole journey, from cowrie shells and pig debts in Vanuatu, through goldsmiths, John Law, the gold standard, shadow banks, right up to Bitcoin and MMT, is this. There is nothing natural or fixed or inevitable about how money works right now.
It's all invented, all based on choices we've made.
Exactly. We know money will look very different 50 or 100 years from now. We just don't know which kind of different it will be. That depends on the choices we make next.
It's that constant tension, isn't it? Between stability and growth, privacy and convenience, the power of individuals versus the power of the state. That push and pull seems necessary.
It seems to be what keeps the system functioning, however imperfectly, and also what drives its constant evolution.
So as you, our listener, think about all this, the goldsmiths making money from nothing, the shadow banks nearly crashing the world, here's that final provocative thought to ponder.
What new form of shadow money might be bubbling up right now? Maybe something you use every day without thinking about it. What system are people treating like perfectly safe cash that isn't actually regulated like money and might be the source of the next global crisis when it inevitably breaks? Where is the hidden leverage today?
Something to think about. Until our next deep dive.